Joining us this morning, Fidelity Investments Director of Global Macro, Jurrien Timmer, is with us, who I'm sure has been listening in. Jurrien, it's good to see you. Of the dual threats that we were just discussing, do you think that one is more pronounced than the other?
I think they're fairly in balance right now. And again, this is really the first time in decades that the Fed has had to really think about both mandates, right? For the last 15 years or so, whenever there was a shock to growth, inflation was below the Fed's target, and it could just really go asymmetrically down towards zero and do QE. I think those days are over. The way I think about it, if a neutral rate is inflation plus 100 basis points, and let's say inflation's 2.5 right now, maybe 2.5 to 3, you got 3.5 to 4. The Fed's at 4 3/8, so it could cut twice and be right at neutral, and I don't really think there's a need for it to be below neutral. But I think the bigger story actually is so I think the Fed probably does nothing, but it certainly has room to cut a couple of times. But I think the bigger story is that what the Fed does just is less important than it used to be, right? What happens at the long end of the curve, which the Fed doesn't directly control, is far more important. So if the bond market concluded that the Fed's cut, if that's what it does, is premature or ill-founded, the curve could bear steepen, and that would be an even bigger problem. And so not many institutions or people borrow at the short rate. I mean, banks fund themselves at 0.5% on their deposit rate, so they have a very steep yield curve already. So I don't think it really matters. What happens to the long end at 444 is much more important, because nothing good happens above 4.5%.
Right. But do you think vigilantes would revolt on a single cut tomorrow?
I don't think they would. But if the Fed learned from the late 60s, not to dial back the clock that long, it pivoted in response to a slowdown, and it took its eye off the ball, and the fiscal impulse was going very strong at that time, late 60s, guns and butter. And it had to take those cuts back and then tighten, because the inflation genie was getting out of the bottle. And so I think the Fed has an eye on the fiscal side of the house. My guess is that it underestimated that in 2021, which is why they overstayed their welcome and didn't take that punch bowl away as the party got started. They wait till everyone was passed out. My guess is that is also a factor here, that they want to lean into that a little bit more, so that inflation genie doesn't come out of the bottle.
Oil, WTI at 72, Brent's at 75. So we're looking at elevated prices from where they were, but I guess relative to history, maybe not so much, given what's happening geopolitically. When does it become a story that matters for the economic outlook, the inflation outlook, and changes the narrative?
Well, the Fed generally looks at core inflation, right? So you take out the things that we actually spend money on, and inflation is running at 2.5, 2.6 on the core PCE. So if there was a perceived to be temporary spike in oil prices because of geopolitics, I think the Fed would look through that, although oil prices do directly affect the TIPS market, so it could actually affect the intermediate side of the yield curve. But my sense is that the Fed looks beyond that. For me, the bigger issue is that pre-COVID inflation was at 2. During COVID after COVID it went to 9. Now it's at 2.5. But it never really crossed below 2, and it needs to do that in order for the average, the 5-year average, to be back at 2. And the 5-year average is at 4 and rising. And so just because inflation's down to 2.5 doesn't mean that the battle has been won, and I think the Fed acknowledges that, and certainly rising oil prices wouldn't help. But I do think that unless it's a lasting impact, the Fed would look through that.
Finally, Jurrien, on the dots, our friend David Rosenberg this morning writes some advice for the Fed. Ditch the dots, essentially arguing that's what a lot of corporates did when it came to corporate guidance. Do you think they mean anything tomorrow?
They mean less than they used to. The Fed is data dependent. I mean, it always is, of course. But in a data dependent mode, the dots really are subject to change, just like the forward curve is, and the forward curve is always changing. The dots were created after the financial crisis, and it was really a tool to create forward guidance at the zero lower bound. In other words, you tell everyone we're not going to raise rates for a long time. At 4 3/8%, the dots kind of have lost their purpose in some ways. So I don't think they really matter a lot. And a real-time version of the dots is the forward curve, the SOFR curve, as we call it. But looking at where the dots are relative to where the forward curve are does tell us whether the market and the Fed are in agreement. And they actually are more or less in agreement right now, and they have been for the last year or so.